There's a night somewhere in your investing life when you open your account and the balance has jumped more in a single month than you saved all year. And you didn't do anything. No raise, no genius stock pick, no extra shift. The market just handed you more than your best month of saving ever could, quietly while you were asleep. Most people miss that night completely. They keep grinding, keep depriving themselves, keep treating every dollar like it's load bearing, long after the thing actually building their wealth stopped being them and started being the money itself. Because there's a specific balance where the engine switches over, where your paycheck quietly hands the job to the market and never gets it back. Cross it, and saving harder barely moves your final number. And the cruel twist is that the people who reach it are almost always the last to notice. My name is Nick, and today we're finding that exact number, why almost nobody's allowed to reach it, and what it does to the ones who make it. This is easier to watch when it has a face, so let me give you two people. We'll call them Maria and Alan. Same age, 38 now. Same city. Same sensible portfolio. They both started investing in their late 20s, and for about a decade, their accounts climbed in that slow, unglamorous way that makes you quietly wonder if any of it is worth it. And then something split them apart. It wasn't income. It wasn't luck. It wasn't some hot stock. It was one single piece of understanding that Alan had and Maria didn't, and by the end of this, you'll know exactly what it is. I'm also going to show you later the one scenario where reaching this number and trusting it too soon quietly wrecks you, because it very nearly wrecked an entire generation of investors and almost nobody saw it coming. So stay with me for that, because this isn't really a video about saving harder, it's about the exact moment the game changes hands, from you to the market, and whether you even notice it happen. So let's find the number, and the math behind it is almost insultingly simple. The whole idea is something people call the crossover point. It's the moment your investments earn more in a year than you contribute in a year. Below it, your savings are doing most of the heavy lifting. Above it, the market takes over the job and it never gives it back. Here's how you find yours. You take what you put in every year and you divide it by the return you expect to earn. That's the entire formula. Let me make it real. Say you're a solid saver putting away $12,000 a year, and let's use 7% as a reasonable long-term return because that's roughly what a stock-heavy portfolio has averaged over the long haul after you strip out the fairy tales. $12,000 divided by 7% lands you at about $171,000. That's your crossover. Once your portfolio passes 171,000, a normal market year throws off more than 12 grand all on its own. The market just matched your entire year of sacrifice while you were asleep, and it didn't even ask for a thank you. Now watch what happens when we turn up the savings. Say you're really going for it, maxing out a 401, somewhere around $23,500 a year. Divide that by 7% and your crossover climbs to about $336,000. And if you're stacking a 401 plus an IRA plus an employer match, call it $30,000 a year total, your crossover sits around $429,000. So depending on how hard you save, the number where the market out earns you lands somewhere between $300,000 and $500,000. And if I have to give you one figure to tattoo on the inside of your eyelids, it's $400,000. That's the neighborhood where, for a committed saver, one ordinary year of return starts quietly beating one full year of your best effort. And here's the part that should make you sit up. It doesn't stop at parity, it accelerates. Because once the market's doing the work, the pile it's working on keeps getting bigger, so its share of the growth just runs away from you. At $400,000, a 7% year is about $28,000 of growth. At $600,000, it's $42,000. At $1 million, 7% is $70,000 a year. $70,000. That's more than double the absolute most you could legally cram into your retirement accounts, showing up without you lifting a finger. Your maxed out ramen noodle, no vacation savings effort is now a rounding error next to what the portfolio does on autopilot. And I haven't even mentioned volatility, which is where it gets almost funny. On a $1 million portfolio, a 15% up year, good but nothing crazy, adds $150,000. 150 grand. Meanwhile, you, sweating, disciplined, heroic you, contributed maybe 24,000. The market's mood swing in a single year was 6 times your entire annual contribution. At that point, saving more isn't the lever, it's a garnish. You're seasoning a meal the market already cooked. Here's another way to feel it, and this one you can do on a napkin. It's called the Rule of 72. Take 72, divide by your return, and you get roughly how many years it takes your money to double. At 7%, that's about 10 years. So watch Alan. At 35, he's got that $400,000 and he essentially stops adding to it. He just lets it sit. By 45, with him contributing basically nothing, it's about 787,000. By 55, it's around 1.5 million. By 65, it's roughly $3 million, and Alan hasn't meaningfully saved a dime since his 30s. His money doubled and doubled again while he was busy having a life. There is no saving schedule on Earth for a normal human income that competes with that. Now, I know what some of you are thinking, and it's fair. This is great for some hypothetical person, but what's my number right now at my age? So let's personalize it, because there's a cleaner version of this idea that answers exactly that. The early retirement crowd calls it Coast Fire, and it's gorgeous in its simplicity. Coast Fire is the amount you need invested today so that without adding another single dollar. It grows into a full retirement nest egg by the time you're 65. Hit it, and you never have to save for retirement again. You just cover your bills. Everything already in the account finishes the job. The math is the crossover point wearing a nicer suit. You take your retirement target and run compounding backward to figure out what you'd need today. Say your target is $1.5 million by 65 at that same 7%. If you're 25, you'd need about $100,000 invested today to coast the rest of the way. Just 100 grand, and you could Alan Reddickly never save another dime and still land at $1.5 million. If you're 35, it's about 197,000. If you're 45 with only 20 years of runway left, it jumps to around 388,000 because there's less time for compounding to work, so more of the weight has to already be there. And notice, Maria and Alan were both sitting on 400,000 at 35. They weren't just at Coast Fire, they were double it. They'd already locked in a comfortable retirement twice over, and only one of them realized it. You see the pattern, right? The younger you hit your number, the smaller that number is because you're handing time the biggest possible head start. $1 invested at 25 is doing decades of work. $1 invested at 55 is basically an intern who shows up on the last day and asks where the coffee is. This is why everyone screams at you to start early, but they forget to explain the actual reason. Starting early is what lets you reach the crossover while you're still young enough to enjoy having reached it. And this connects to the thing that fools almost everyone in their first few years, which is that compounding feels like a scam right up until it doesn't. Growth isn't a straight line, it's a curve that stays flat and boring for a painfully long time and then goes vertical near the end. Over a 40-year investing life at 7%. Something like 80% of your final balance is growth, and only around 20% is money you actually contributed. Let that land. 4/5 of what you end up with is stuff the market made, not stuff you saved. And most of it shows up in the final decade when the snowball is finally big enough to matter. The first 10 years you're shoving a stalled car, the last 10 you're watching it roll downhill on its own while you jog alongside pretending you're still pushing. Which brings us back to Maria and Alan because now the split makes sense. Around 35, both cross that 400,000 line. Alan notices. He does the napkin math, sees the market is now out earning his contributions, understands the hard part, the part where his savings built the base, is finished. So he eases off. He still invests a little, but he stops treating every dollar of spending like a moral failure. He takes the trip, he works a little less, he lets the machine run. Maria doesn't notice. Maria still declines the wedding invite because the flights are $300. She still runs the grocery total in her head before she reaches the register at 55 with more money than she will ever spend. She still opens the banking app first thing every morning like it might have betrayed her in the night. And here's the gut punch we'll come back to. By 65, Alan, who mostly stopped, has about $3 million. Maria, who never stopped, has about $5.3 million. In those 30 years, Maria personally shoveled in over $700,000 of her own money. The market handed Alan $2.5 million while he was functionally asleep at the wheel. Her entire 3-decade grind added less than the market added to a guy who quit. But before we get to how that story ends, I have to be honest about the giant asterisk on this whole video. Everything I just described, this magical crossover, this point where you get to breathe, it assumes you can actually get to $400,000 in the first place. And I need you to hear the real numbers, because most of the internet won't tell you this part. The median amount of retirement savings for an American household is about $87,000. Median, that's the household sitting in the exact middle, and it isn't remotely close to the crossover point, even for a modest saver. Now, you'll hear a very different number thrown around, the average, which is about $334,000. And that gap right there is the most important thing in this entire video. The average is nearly 4 times the median. Why? Because averages get dragged upward by a handful of enormous accounts at the top. It's like when Jeff Bezos walks into your neighborhood bar and, on average, everyone in the room is suddenly a billionaire, and yet somehow nobody can close out their tab. A few giant balances pull the mean way up, while the typical person sits way down at 87,000. When someone tells you the average American has a third of a million saved, they're technically right and completely misleading. The average American looks like they're approaching the crossover. The typical American, the one in the middle, isn't in the same solar system. Only about 5% of households have a million or more in retirement accounts. And I want to be clear about why, because this is where a lot of finance channels get cruel and stupid. They'll tell you the median is low because people are lazy or bought too many lattes or lack discipline. That's garbage. The reason most people never reach the crossover isn't a willpower problem. It's, an income problem. Wages haven't kept up. Only a small slice of people can even afford to max out an account, and the cost of simply existing eats the margin that used to become savings. You can't divide your contributions by 7% to find your crossover if there's nothing left to contribute. So if you're watching this and your number feels 1,000 miles away, hear me. You are not failing. You're playing a game that got quietly rigged while everyone was busy blaming you for the score. Oh, and before I forget, because it fits right here, if you're the kind of person who wants to actually change the income side of that equation, not just slice your existing paycheck into ever smaller pieces, I built a school community where I break down exactly how I think about building extra income streams and using this stuff in the real economy. It's free, the link's below, and honestly, it's the lever that moves the needle once your savings rate is already as tight as it's going to get. Okay, back to it. Because here's the twist I promised, and it's the part that makes this almost tragic. Remember Maria. The people who do reach the crossover, the roughly 5% who clear the bar, mostly refuse to believe they've won. There's real research on this. Studies of retirees who entered retirement with $500,000 or more found that after almost 20 years, they'd spent down only about 12% of it. 12%. And roughly a third of retirees actually grew their wealth in retirement. They got richer during the exact phase of life they were supposed to be spending it down. These are people who won the game so decisively they pulled off the one financial outcome nobody ever plans for, dying rich by accident. And notice this isn't the usual retire at 40 fantasy, this is narrower and stranger. The math says only a sliver of people ever clear the crossover, and then that same sliver, the ones who finally could exhale, are the ones who can't put the shovel down. There's a name for the trap Maria's in. Some people call it one more year syndrome. You hit your number, and instead of freedom, you feel like the number needs to be bigger. It creeps from 1 million to 2, from 2 to 3, always just out of reach, and you keep trading your healthiest, most alive years for a pile you will statistically never touch. Bill Perkins wrote a whole book on this, arguing the goal shouldn't be to die with the most money. It should be to die having actually used it, on experiences, on people, on the life the money was supposed to buy. Maria crossed the finish line at 35 and just kept sprinting, because nobody ever told her the race was already over. Now, earlier I promised you the one scenario where reaching this number and trusting it too soon quietly wrecks you. Here it is, and it's the reason I won't let you walk away thinking saving never matters. The crossover has a dangerous assumption baked into it that the returns actually show up. 7% is a long-term average, and averages are liars over any short stretch. Ask anyone who invested from 2000 to 2009. Over that entire decade, the S&P 500 delivered a return of roughly negative 1% per year. 10 years. A dollar went in and crawled back out as 91 cents. Imagine gritting your teeth through the whole 2000s, dial up to the iPhone for a negative return. That's not a portfolio, that's a hostage situation. And if you decided in 1999 that the market would carry you and quit saving, that decade would have flattened you. During stretches like that, your contributions are the only thing keeping the ship moving. There's more. There's something called sequence of returns risk, which is a fancy way of saying the order of your returns matters enormously right before and after you retire. A crash at the wrong moment, right as you start withdrawing, can gut a portfolio that would have been perfectly fine if the same crash had shown up 10 years earlier. Same average return, wildly different outcome, purely because of timing. And then there's us, our own behavior. Firms that track this, like Dalbar, have found for decades that the average investor badly underperforms the very funds they own, because they panic sell at the bottom and pile back in at the top. The market offers you the return, your nervous system talks you out of half of it. On top of that, some of the biggest names on Wall Street, Goldman among them, are currently forecasting returns for the next decade well below the historical 7%. If they're even close to right, every crossover number I gave you is further away than it looks. So here's how to hold all of this at once, because both things are true. Saving more barely matters, and saving more is the only reason it ever stops mattering. Read that again. The crossover is real, but it's a reward, not a starting line. You don't get to skip to the part where the market carries you. The only way to build a base big enough for compounding to take over is to save relentlessly, especially early, during exactly the years when it feels slow and pointless and broken. Your contributions are the one variable you fully control. The market's returns, inflation, the timing of the next crash, none of that is up to you. Your savings rate is, so you pour everything into the one lever you can actually pull, right up until the day the machine is finally big enough to pull the others for you. That's the whole thing, really. There's a number somewhere around $400,000 for most committed savers, where your money starts outworking you, and every year after that, it outworks you by more. Coastfire gives you your personal version of it by age. Compounding guarantees the back half does the heavy lifting. But almost nobody reaches it, not because they're weak, but because the income was never there to begin with. And the ones who do reach it too often can't stop, guarding a fortune they'll never spend while the years they could have spent it in quietly slip past. So picture Maria and Alan one last time. Same age, same city, same funds. Alan saw where the line was, and the moment he crossed it, started actually living, and still retired with more than he'd ever need. Maria never saw the line, so she kept grinding for a number that had already stopped mattering and bought herself an extra $2 million she'll die still holding. At the price of 30 years she doesn't get back. Both of them made it, only one of them noticed in time to enjoy it. Don't be so busy saving for a life that you miss the exact moment you're finally allowed to live it. Find your crossover, and when you reach it, have the nerve to act like it. Quick reminder before you go, I'm not a financial advisor, and this isn't financial advice. It's math and some hard-earned pattern recognition from watching how this actually plays out for real people. What you do with it is on you. If this reframed the way you see your own account, and you want the deeper stuff on building the income that gets you to the number in the first place, that School Community is waiting, links in the description. I'll see you in the next one.